Ladies and gentlemen, good day and welcome to the TCI Express Q1 FY2026 earnings conference call hosted by ICICI Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Mohit Lohia from ICICI Securities Limited. Thank you, and over to you, sir.
Yeah, hi. Thank you, Nidhi, and good evening, everyone. Thank you for joining us today for Q1 FY26 call of TCI Express Limited. First of all, I would like to thank management for providing us the opportunity to host the call. From the management side, we have Mr. Chandan Agarwal, Managing Director, Mr. Muktilal, Executive Director and CFO, Mr. Pavitra Mohan Panda, Senior Chief Sales and Marketing Officer. So without further delay, I would now hand over the call to management for the opening remarks. Thank you, and over to you, sir.
Good evening, everyone, and welcome to Q1 FY26 earnings conference call for TCI Express Limited. I would like to thank all of you for joining us here today. I hope you and your families are staying healthy and fit. We have already circulated our earnings presentation on our website and stock exchanges, and I trust you have reviewed it. To begin, I will provide an overview of our business scenario and the performance of our service offerings for the quarter. Following that, I will hand over the call to our Executive Director and CFO, Mr. Mukti, who will walk you through the financial performance for Q1 financial year 26. The first quarter of financial year 26 marked a steady beginning for the company, with TCI Express sustaining its momentum through disciplined operational approach and continued investments in network expansion. Performance during the quarter reflected balanced contribution from all service verticals, supported by evolving customer requirements, growing demand across industrial segments, and the company's strategic focus on multimodal logistics. The Surface Express division remained the largest contributor to overall business, driven by demand from sectors such as retail, automotive, and industrial goods. Operational consistency ensured sustained volumes and service levels. The Rail Express segment continued to strengthen its network, supported by infrastructure improvements and increased adoption of cost-effective and environmentally compliant rail-based solutions. The Domestic Air Express division further expanded its last-mile connectivity, while the International Express division handled over 100 tons of cargo through multiple Indian gateways, recording a 33.25% year-on-year revenue growth. The C2C segment registered growth of over 14% during the quarter, in line with our focus on diversifying and strengthening revenue streams. During the quarter, we added 10 new branches to enhance last-mile delivery and capabilities to improve customer accessibility in key regions. In addition, new sorting centers were commissioned in Nagpur, Raipur, and Indore, collectively spanning over 2 lakh square feet. These facilities represent a significant step in our infrastructure expansion and will strengthen our processing capacity in central India. Our multimodal capabilities remain a core element of a long-term strategy, contributing to operational flexibility and optimized service timelines. Despite industry headwinds such as elevated freight rates, inflation in labor costs, and higher compliance expenses, our asset-light model, surrounded by agile network management, enables stable freight pricing and consistent service delivery. Through disciplined execution and focus on cost efficiency, we maintained stable revenue performance in Q1 26. This was supported by steady volumes, improved productivity, and an optimized cost structure. Profit after tax for the quarter stood at 21 crores. We are pleased to share that TCI Express has been certified as a great place to work for the 5th consecutive year, reaffirming our commitment to employee engagement and workplace excellence. As part of our CSR initiatives, the TCI Express Foundation, in collaboration with TCI Foundation, established an archery academy in Khunti, Jharkhand, to support tribal children through structured coaching, quality equipment, and regular training sessions. Looking ahead, we will continue to focus on expanding our infrastructure and strengthening service capabilities. Plans are in place to replicate automation technologies at upcoming facilities, expand our branch and service network, and further develop the multimodal segment through targeted sales and business development initiatives. We are also working to increase our presence in complex sectors such as aerospace and engineering, while scaling the Air Express network beyond metro cities to improve coverage. We remain optimistic about the upcoming festival season, which is expected to result in higher volumes across retail, electronics, auto, and lifestyle products. The company is well positioned to manage the anticipated demand through its expanded network, upgraded infrastructure, and strengthened multimodal capabilities. With a clear roadmap, TCI Express remains committed to sustaining growth through operational excellence, service reliability, and strategic execution in the quarters ahead. With this, I would like to now hand over the call to Mr. Mukti to talk about our financial performance for the last quarter.
Yeah, thanks, Sundar sir, and good evening, everyone. And thank you for joining us today. I will now take you through the financial performance of the company for this first quarter. And as Mr. Chandra has already briefed about the overview of the business and environment and key development during the quarter, so I will focus on financial performance, service-wise, my service offerings updates and operational progress, and our strategic priorities. So basically, this quarter we have achieved a revenue of 287 crore rupees, and this is reflecting a sequential decline of 6.7% and 2% is on a year-on-year basis. And total income of the quarter is 290 crore rupees. EBITDA for this quarter was 33 crore rupees, and it is a margin level stood is 11.5%, which is compared to 10.5% in Q4 and 12% in Q1. And profit after tax is again just 21 crore rupees with a margin level of 7.3%. Despite the revenue moderation, our margin, margin profile remains resilient, supported by operational efficiency gain, higher network productivity, and improved business mix. The benefit from the automation at our sorting center and disciplined control on direct costs help offset part of the volume softness. So now I am giving service offering wise performance. So international express registered growth during the quarter, supported by higher volumes through key gateways and increased customer adoption. First time in a quarter we achieved 100-ton transportation for Air International. The service continued to handle both outbound and inbound flows, provide two-way capabilities to clients. Same way Rail Express reported stable growth with further expansion of network coverage and customer base, alongside a higher proportion of repeat businesses. It remained positioned as an option, balancing cost efficiency and delivery timeline across key routes. So again, about C2C Express recorded also an expansion in business during the quarter, supported by new customer acquisition in core industry sectors and increased adoption of customized delivery solutions. Efficiency in operation was achieved through route optimization and effective utilization of return loads. We continue to provide the expansion of our edge multimodal portfolio with the objective of increasing its overall contribution to the revenue mix over the medium term. Apart that, we also spent 13 crore rupees on a capital expenditure towards branch expansion, sorting center construction, and IT infrastructure upgradation. This is part of our multi-year capex plan, under which we already spent investment almost 200 crore rupees in the last 3 years. We continue to operate with zero debt balances. Receivable days were maintained at 58 days. Payable days are 35 days. So net working capital cycle is maintained at 23 days. Consistent with our historical performance. Our asset-light model allows us to fund expansion entirely from internal accruals while maintaining strong liquidity, and we will be maintained for the whole year and time to come also. So our priorities remain focused on expanding multimodal capabilities along with surface expansion also. We have to increase the contribution of multimodal services in overall pie from current level of 17.5 to 18 to 20 to 22% in over the next to 2 to 3 years. The strategy includes widening customer penetration in high potential industrial verticals, scaling international express volumes, and leveraging technology and automation to improve productivity. And also like in we also strategize where we earlier thought put on one team for the whole multimodal product. Now we decided to keep each service offerings have a separate throughout the ecosystem network from top to bottom. So we creating that way also. So we creating for air and international, and then rail and C2C is a completely different. From top to bottom, we creating in a separate team and separate network for that. So on sustainability, on the other sustainability side, or you can say like grain logistics, we are piloting EVs for last mile and mid mile operation in selected cities, and implementing renewable energy solutions, including solar rooftop at newly built up these 3 sorting centers, as Mr. Chandra has mentioned. So ESG remains an integral part of our long-term strategy approach and business. So to conclude, Q1 was a steady start to the year. We maintained stable margin despite a modest decline in revenues, continued to invest in network expansion and automation, and upheld our strong balance sheet and cash flow profile. We are confident that our strategic direction and disciplined execution will enable us to capture growth opportunities in the quarter ahead and deliver sustainable value for all stakeholders. So now thank you very much, and now we can open the floor for questions, please. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Krupashankar NJ from Avendus Spark. Please go ahead.
Good evening, and thank you for the opportunity. My first question is on the tonnage part. So while you have mentioned it's quite soft, any number you can provide on what would have been the tonnage for the quarter?
Yeah. Well, so tonnage is 233 lakh ton for the quarter.
Understood, sir. With respect to improving efficiencies in the existing network on the surface express side, just wanted to get a sense on, the utilization levels are at around 82%. Want to know, how are you trying to improve that in the surface express business? Any measures taken on that front?
Yeah, well, so as you are aware, volumes are soft. So last year we were highest, we touched around 83.5, and then we maintained 82% for the whole year, and this is a good thing. In spite of slightly decline in volume, we are able to maintain 82%. So surely once we add the volumes, then certainly we will be reached back to 83.5 to 84% for the surface for sure. But side by side, we also adding the capacity or network expansion for my air domestic and air international product, and as well as for rail. So for them, we're creating a separate network. So that cost is also adding in this my overall direct cost.
Is it fair to assume that the margins of the surface business have been higher, and it is just because the other businesses are scaling up, the profitability is relatively lower? Is that understanding correct, or any other thoughts you can share on what can drive margins from current levels?
So if you talk about margin levels, so margins in surface, air domestic and rail are more or less equal, and slightly less in air international business, because this is a very competitive business, and it's a high volume business basically. So that's it.
Okay.
Yeah.
Sorry, you're adding something, sir?
Sorry?
No, last one, what I wanted to know is that going ahead, is the growth expectation in the international air business going to drive our top line growth over the near term? Is that going to be the key driver?
So basically, not only air international, it will be like all the multimodal products like rail, air, domestic and international and C2C put together. They will be the growth driver also. But like surface is our key business. We still have the 80 to 83% businesses surface. So that has to be also drive the growth. But we want to be slightly higher growth in this new segment. That's why we're creating a team. So our target is to strategy, supposing we altogether achieving a growth of double digit or like 10-11%, then we maybe achieve 8% growth in surface and then 14-15% overall growth in multimodal products. So that's the target, and margin level will be certainly improve once we will get the volumes and revenue growth, and we will be back to normal margin levels. So profitability-wise, all products, doing very well, but somehow some capacity is unutilized in new, network we're creating for first mile and last mile deliveries for these new services like rail and air, because mid mile is already decided as a train and, flights. But first mile and second mile, we creating more network to be reached customer very fast, and to service level has to be very high. So that somehow it is slight vacancies there, which will be once we will be picking the volume in gradually, then it will also fill up.
Understood, sir. Thank you. I'll get back to you.
Yeah.
Thank you. The next question is from the line of Dhruvin Kadakia from SKP Securities. Please go ahead.
Hi, sir. I actually wanted to understand that with respect to our capex that we have till FY27, it would be really kind if you could give me some kind of a breakup as to how much are we planning to incur in FY26 and FY27.
Yeah, well, so we have taken a target for the last 3 years and including 26 and 27. For the 5 years, we've taken a target of 500 crore rupees capex plan. Of that, in last 3 years, we spent 200 crore rupees. Now, I think in this year, we will be finished with the 100 crore. And again, in next year, again, 100 crore. So this way, I think we will be finished, and out of 500, we may be 400 crore plus. That's I think we will achieve by 27. And then once we will be in the mid of year of 27, then we will be finalized again the next 4-5 years capex plan.
So is it safe to say that these 500 crores, chances are that it will extend beyond FY27, like it can happen till FY28?
Yes. That's the high probability, yes.
All right, sir. And any guidance that you would like to give with respect to EBITDA margin, volume growth or realization growth for the next 2 years?
In this year, we're targeting, volume growth is in higher single digit, like 8-9%. And with the price hikes, we will want to be 11-12% in FY26. And then in the next year, around volume growth, again, double digit. And then profit margin is around 15% in revenue growth. 13% revenue growth. And margin would be back to EBITDA will be normal in 15% to 16% range.
Okay, sir. That's all from my side. Thank you so much.
Thank you.
Thank you. The next question is from the line of Achal Lohade from Nuvama Institutional Equities. Please go ahead.
Yeah, thanks for taking my question. Sir, if you could help us understand in terms of 200 crores you mentioned in terms of capex, but I presume the OPEX is also hurting us. Is there any estimation as to what is the extent of, the under absorption of these costs? Or let me put it in another fashion. If you could help us understand on the Surface Express, which has been our core in the past, what is the margin compression we have seen, from a 15%, has it fallen to a 10% or 9%, or it is still 13, 14, but balance 400 pips impact is because of the other verticals?
Yeah, well, so you rightly said there is no margin compression itself in Surface Express because this is the biggest service we offering here. Margin is slightly like decline in other multimodal product where because we see a inflationary pressure or duopoly by these airlines and airport privatization in air segment. And obviously this increase in air international is slightly low margin business. Its EBITDA margin is around in the range of 10 to 12%, but though it is not in a big business right now, it will be grow. That is our like long-term strategy to be like de-risk the revenue stream because we are usually like depending on the one segment of business. So though we de-risk ourselves by the clientele ratio because we have high clientele and Surface, but we want to be de-risk ourselves with the diversification on the service level also. So that's why we want to strengthen this multimodal services or other services, these offerings also. So that's why we simultaneously creating a team for these other services also. So that's why margin is slightly less on these. Otherwise, on operating level, these also like very good margin and other services also, except this one Air International business.
Sir, I'm a bit lost. If you could elaborate a little bit very clearly. So let's say, you have said 17% is our the other verticals, right? 83% is Surface Express. Have I understood the number right?
Yeah.
Correct. You've said that your margins are fairly stable for the Surface, which used to be 15% before, right? That alone can give me 12% EBITDA margin. Yes.
Yeah, now it is around 13%. Yeah.
13, okay. So there is a 200 bps contraction there. Yeah. And that is driven by what? Is that to do with the pricing, competition, or simply you're not able to take a price increase? What is it?
Yeah, so it's a combination of three things because we faced this challenge in the last year. This year, hopefully you have seen the numbers, they are the like same cost what we have in the last year. So basically that was happened due to toll tax increases and labor wages increases, and we were not able to passing on to customers. So that's why that contraction happened on like 200 basis point in last year only, 150 basis to 200 basis point. This year we trying to be like increase the prices which we already taken in this Q1 almost 75 basis point in prices. And we will be keep continuing this year. We are targeting to increase at least 2% in overall pricing from the Surface segment. So we're working on that. That's our strategy. Right.
So let's say, sorry, I'm just trying to clarify for the sake of understanding. So you're saying that 83% is at 13%. That alone gives 10%. So that 17% is at zero margin. Have I understood right?
No, not zero, but they are very less margin because we're creating a network for that. So that's why, because in each month we adding the branches, we adding the vehicle to like get more businesses on rail and this air. So that's why supposing we put, so each month we adding the capacity. I think we will be streamlined that one in Q2, more or less. Then after that we will be like building the capacity and building the customer base, and then we will be further if need and some expansion, then we will do after that only. So we will be finish that. And other thing also, like we creating a team for this business also. So that cost is also adding. That will be, I think we will be finish the hiring by September end, and then it is normalized. So margin level would be again in that way. EBITDA margin would become in the range of 14 to 15% for this multimodal products also put together.
Understood. And just last question, if I may, with respect to the capex, what we have spent on the automation, right? Of this 200 crores or of the total 400 crores, what we will end up spending between FY23 to FY27, right? 23, 24, 25, yeah, right? Of this, how much is going for the automation and how much is going for the new branches, new locations, new warehousing, etc.?
Yeah, well, so basically for automation put together, we will be considering like 2 we already did and 2 more will be did by 27. So total put together CapEx is around 80 to 100 crore rupees on automation, and remaining on construction and land buying and all. So this is the ratio for that. So 25 and 75. Because branch expansion, we really don't need much because there's an OpEx is there for the we putting the vehicle for additional and all. But put on a branch network, we don't need to put anything much CapEx for that. For the one branch, I think 1 and 2 lakh rupees is suffice for that. Sometime in a supposing we opening up the branch for the rail, so we might putting in a same location. So there is no additional CapEx we need to put there.
Understood.
Yeah. So
and just
we really don't need CapEx, and hardly it is basically going into 90% plus is going into this sorting center only.
Right.
Yeah.
Okay. And just one factual question. Is there any overlap in terms of the operations between us and TCI, whether it is last mile or mid mile, as in line haul, or the warehousing, or the corporate office at all?
No, since inception of this division, as we are a part of TCI, since that time we were not having any kind of operation together, except a few offices we sitting together because these are the admin offices, like regional offices or controlling offices and all. Other than that, nothing we are doing anything is overlapping there.
They are already totally independent. Okay.
Independent, and business line is also completely different because we do air, they're not doing air at all. They're doing shipping, we are not doing shipping. So completely different service offerings and different network and altogether.
Got it. This is very helpful, sir. Thank you so much.
Thank you, please.
Thank you. Before we take the next question, I would like to remind the participants, anyone who wishes to ask a question may press star and 1 on their touchtone telephone. The next question is from the line of Ashwin Reddy from Samatva Investments. Please go ahead.
Yeah, hi, good evening. My first question is on regarding the multimodal transportation what we're doing. So what are the broad timelines by when we believe the margins will come back to the surface level? So is it 1 year away, 2 years away, or how far are we from when the margins will start to come back to company level margins?
Yeah, so basically on multimodal and other offerings, we will be almost done the expansion and for current time. So I think by September we slightly face margin pressure on multimodal. After that will be because the building of the revenues also in additional network we created, and we also putting team for the more businesses. So I'm hopeful Q3 onwards we will be normalized in the range of 12 to 14% margin level will be start in multimodal as well. Because then we will be able to utilize this network, fully or in a maximum level. So that will be directly add to our profits.
Got it.
Because our strategy is very clear. We are not putting extensive network which is creating a loss to us because we are not like a startup company. So whatever we are doing as a sustainable basis and gradually we doing. So we at least have to be some margin on these businesses. And we building up the capacities over the period, so gradually. So we are not putting something in 1 year and then utilizing that way. So we going gradually. So whatever we did initially, we did that, and Q3 onwards it will be normalized as a margin level.
Got it. So just to extend the same question, now the clients that you get here, are they? What is the overlap with your existing clientele that you have? Is it primarily the same customer, or are you going out and getting new customers for this business?
Yeah, so it is basically kind of almost 50-60% the same client, which is need in a different, like pharma company you take, so they also doing surface they taking from us. Earlier they using continuously air services. Now we also convince them to be use rail services wherever they fast, kind of mid solution in times of tag. like surface and air in between they want. So service offering to same customer is like repetition of this 50-60%. So customer base is almost same.
Got it. And my second question is on regarding the approach to e-commerce segment. Has there been any change in your approach to e-commerce, and has there been any change in the e-commerce industry itself? Is it now more viable to get more aggressive on e-commerce, or what? Or any thoughts there would be helpful.
Yeah, that is a very good question. So basically, I just also forget to that for the Air International is a completely different customer. I just forget to mention and answer your last question. So there is a customer base is completely different. But other these services like either is a C2C or air domestic or rail is almost like 50-60% customer are the same. So I am like now giving a answer for the next question. So basically for e-commerce, yes, we repurchase our confidence on to restart the business for the e-commerce customer. Though we have already for the very few customer, now we creating a separate team and refocusing on, because we seeing market stabilized. Whatever we doing is visible, whether we will be under profit or not profit. So we going in a small customer because new entrants are also there. Now brand also doing direct deliveries to customers. So D2C model is also working here. So we focusing again as a gradually, and we will be go with the only profitable approach only. We will not be invest anything which is making loss for the company. So we are very much clear on that. So we repurchase.
But is this more of B2B or B2C? Is what you're focusing on the last mile delivery? What you're focusing on, or is it more on the B2B within e-commerce?
So B2B are normal for the as a surface we doing since long and is always in a focus. But now we focusing more into in B2C as well. So we employing the team there as well.
Got it. Thank you so much.
Yeah.
Thank you. The next question is from the line of Kondinya Namagada from Jefferies. Please go ahead.
Yeah. Hi, sir. Thanks for the opportunity. So, sir, starting with, if you can little bit throw some color on what is some of the macro background for the quarter gone by during the volume growth, and what is your outlook? I mean, 2Q, really 50% of 2Q is already done. So what is the how is it looking like at this point in time? If you can speak a little bit about it, please.
Yeah, well, so few positives happened in this quarter, cost visibility is there. So we have established the cost and what the pressure we feel in a whole last year for the increase in labor cost or increase in toll cost and other costs. So that is slightly stable. Second, business environment is slightly more probable now. Earlier is more uncertainty what customer committed, but until ultimately we not get that. But now it is slightly certain in some cases. But still we facing 2-3 segments especially engineering companies are really not. They are kind of having the growth of moderate growth or flattish growth continue. And same way lifestyle companies also doing the same way. But few segment has grown well, pharma is up to stake, taking shape, and new segment of pen division or kitchenware companies, they're doing very well. So that's way is a mixed bag. Basically, few segment is really doing well, and few segment is still having flattish kind of growth.
Sir, so I mean, if I were to look at your guidance, right, you need to do about a 12% kind of growth at least for the balance 9 months, vis-a-vis decline in the current quarter. So how do you see this growth recovery part? Is it going to be immediate, or are you saying it's going to be back-ended? Because this year our festive season is front-loaded, but still you are saying that we haven't seen any recovery on the macro outlook. And at the same time, if I were to look at our volume growth side, for some reason, one of your peers, they are reporting a really good set of numbers while you are lagging. So just trying to understand, the difference with respect to the commentary and also delivery part. What is happening and how do you intend to achieve your guidance?
So yeah, well, our key businesses again surface, and we focusing on wherever with the high growth high growth like in pharma and this other segment I mentioned. So we will be focusing more and putting more sales team to achieve the higher revenue growth there. Second, multimodal, as we mentioned, and also given very good numbers in Air International and C2C business. So these numbers, again, you've seen like 14% growth and 33% growth and kind of numbers. So we're seeing slightly higher growth traction in these multimodal segments, and kind of like 6-7% growth in, or you can say like around 8% growth with together price hiking. We are hopeful will be achieved because now certainty is slightly higher than last year. That's the only thing I can say.
Okay, so certainty, as in you were saying that at least there will not be degrowth, maybe it's at least bottoming out at least on the negative growth front. Is that what you're trying to highlight?
Yeah.
Sir, can you put a number on, you used to give this SME versus corporate customer mix. What is it now and what was it earlier? Because I think you also earlier in one of the previous calls spoke of increase in the corporate mix to an SME weakness. So how is it now?
That is also like in positive side. So we have improved that earlier. Last quarter, I think in whole year we maintained 52 corporate and 48 as a sundry. Now it is 49 in a sundry and 51 corporate because our again target to be achieve 50-50. So that is also going well. That way I am hopeful because sundry side slightly we have very positive signs to for the every customer. So we will be improve on that as well. So ratio would be by year end would be 50-50, and that is also like directly add to our profit margin. That's why we very confident to be achieve higher profit margin in this year.
Sure, sir. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Pravesh from Fourline Capital. Please go ahead.
Hi, sir. Thank you for the opportunity. One quick clarification. You mentioned that the multimodal even today is, between 70 to 80% of the revenue. And we have seen, very high growth on both C2C and Air International, as you said. So I'm wondering why is that mix not increasing in the overall revenue? Because this was the same 17 to 80% even in Q1 FY25.
So basically, you rightly said. So, that number was, for the whole last year was around 17%. Now it is near to 18%. But sometimes, earlier we have the e-commerce business was around 3% in overall, but now it is almost reduced to 2%. So this year onward, we again focusing on that's the reason there's a maintain is around 18%. Because again, numbers are almost these numbers like we have the growth in Air International business, which is very small business right now, which will be grow. So this number is around 18% now.
Understood. What was our growth for the Rail Express business this quarter?
It's around 8%.
Understood. Secondly, in terms of branch openings, I think we had a target for 80 branches this year. We've done 10 in this quarter. How much have we done in Q2 till now?
Q2 we only opened 3 branches in this July month. Because, overall our internal meetings and all. So that's why focus was slightly less to open the branches. And maximum branches I think we will be open in September month. In this quarter, may not be like more than 12 or 13 branches in this quarter as well.
Got it. Understood. And lastly, when are you thinking about the 2% price hike that you mentioned, and what's the confidence that this time we'll be able to get it through the customer?
It is so it is consistent process as I had taken in quarter one is around 75 basis point, and same way we want to be like 60 to 75 basis point in this quarter. So it will be continuous process because after that, so we targeting to improve almost 2% that will be happen by I think in Q4 it is not possible to take hike because that's the business time. So usually it happen whatever happened till calendar year end.
So by this December, I think we will be finished this process.
Understood. Thank you.
Yeah.
Thank you. The next question is from the line of Janam Shah from Equirus Securities. Please go ahead.
Yeah. Thanks for the opportunity. Sir, I joined the call late. If you can give me the volume number for this quarter.
Yeah, so volume number is exactly 233,000 ton, Janam, yeah.
Got it, sir. So what I see over here is that the volume is degrown by around 1% for the quarter. And when I recollect the transcript of the last quarter, after April and May, the volume is expected to grow in the low single digit during those 2 months. So eventually, can we say that June has been kind of a worst quarter for us, which led to around from plus, let's say, low single digit to minus 1% growth for this quarter? So has that been the case or something else would say?
No, basically, like April, it is like a journey in a different way. So June, we were expected slightly higher volume, but June did not that way. May was okay. May was fantastic. And April was, basically like slightly okay. But June was the biggest, that way. And July is again, good month. So somehow, now revenue has stabilized. As you see, like decline in the volume is hardly like less than 1%. So this is okay, but we were focusing more into in this quarter too. And visibility, I can say like visibility is there for the like in quarters. Last year we faced as visibility uncertainty was high. So that we overall basis in overall customer base, we seeing certainty is like higher than last year and the visibility is slightly high. So that's way. Yeah.
Sir, the line for the current participant has disconnected.
Yeah, no worries, please.
A reminder to the participants, anyone who wishes to ask a question may press star and 1 on their touchtone telephone. Ladies and gentlemen, anyone who wishes to ask a question may press star and 1 on their touchtone telephone.
If there is no question, we can be like conclude the call right now, maybe.
Okay, sir. As there are no further questions, I would now like to hand the conference over to the management for closing comments.
Chandra sir, your comment, please.
1 second. Thank you all for joining us today. We have endeavored to address all your questions. Should you have any further inquiries, please feel free to reach out to our investor relations team and we would be happy to assist. We look forward to connecting with you in the next quarter. Wishing you a healthy time ahead and a happy Independence Day and Krishna Janmashtami in advance. Thank you.
Thank you, everyone.
Thank you. On behalf of ICICI Securities Limited, that concludes this conference. Thank you for joining us and you may now disconnect your lines.
Thank you.
Thank you, please. Bye.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.